Welcome back to the Deep Dive. It is Tuesday, February 10th, 2026. If you were tracking the macro landscape last week, the prevailing theme was systemic fragility.
Definitely. We were all watching trade wars, minor capitulation.
It really felt like the floor was about to fall out. But we need to shift gears immediately.
We do. Because the data from the last, say, 24 hours suggests we're not looking at a crash anymore. We are looking at a fracture, a fundamental split in the market structure.
A fracture. That's a good word for it. We're calling this asymmetric realignment.
And it just fits.
It does. It captures the nuance. I mean, usually when we cover this sector, correlations are tight, Bitcoin moves, miners move with it, Asia follows, regulators react. It's like a synchronized swim.
And today, the Krimmers are all going in completely different directions.
Exactly. So our mission for this deep dive is to map out these fractures. We are sticking strictly to a what's new versus what we knew framework today.
Right. We're not going to rehash the basics of mining difficulty or the history of the kimchi premium. You already know that.
We're focusing entirely on the delta, the net new developments from this morning's briefing that actually changed the rules of engagement.
Clinical and direct.
I'm on board. We have three main targets. First, corporate bifurcation. Specifically, how the mining sector is just, tearing itself apart between AI and Bitcoin. Second, we're heading to South Korea. There's a sort of regulatory Sputnik moment happening, triggered by that exchange error.
And third, the White House. There's a showdown on sovereign yields that's happening literally as we speak.
Okay, let's start with the miners. This is where the divergence is, I think, most visible.
It really is.
Let's set the what we knew baseline.
Yeah.
So coming into this week, the narrative was distress. We had Winter Storm Fern taking power offline.
And we had that massive negative 11.16% difficulty adjustment on February 8th.
Right. So the market just viewed miners as a leverage beta on Bitcoin. If you bought the stock, you were just betting on the coin. Simple as that.
Correct. That was the old correlation. But the data from the last 24 hours has just smashed it. We have two major corporate moves that are, diametrically opposed.
Cango Inc. on one side, MicroStrategy on the other. This really signals the end of the monolithic miner trade.
It does. Let's dissect Cango first, because this is the headline grabber. Cango Inc., ticker CANE, confirmed a massive liquidation over the weekend.
This is the what's new. They sold 4,451 Bitcoin.
Which, to put a dollar figure on it, is approximately $305 million. They executed that at an average price of around, $68,500?
Now, normally, when a miner dumps $300 million in spot BTC, the market assumes insolvency.
Yeah, the assumption is that they're selling to pay the electric bill or service some debt.
But that's not what's happening here, is it?
No, and that is the critical distinction. This is not distress, it's strategy. This is margin arbitrage.
So they're not selling to keep the lights on?
No. They're selling to pivot the entire business model. They are taking that $305 million and pivoting 100% to AI compute infrastructure. They are buying GPU nodes.
So they're looking at their balance sheet and saying, okay, we are currently valued as a Bitcoin miner with a low earnings multiple.
You're right.
If we turn this Bitcoin into NVIDIA chips, the equity market will value us as an AI company with a much higher multiple.
Precisely. They are trading a lower multiple asset for a higher multiple asset. They even hired Jack Jin, the former executive from Zoom, to be their new CTO. They're effectively saying to shareholders, we are no longer a crypto stock, we are a compute utility.
That is a massive signal. But then you look at the other side of the ring, you have MicroStrategy doing the exact opposite.
At the exact same time. The counterpunch, this morning MicroStrategy filed an 8K. They didn't sell, they bought.
They bought. How much?
They purchased 1,142 Bitcoin for about $90 million. The average price was way higher, too, around $78,815.
And the funding mechanism here is key. Cango sold Bitcoin to buy tech.
While MicroStrategy sold equity to buy Bitcoin, it's the perfect divergence.
It really is. MicroStrategy is just doubling down on their Bitcoin standard treasury model.
Their thesis is that the scarcity of the asset is the ultimate value driver. Cango's thesis is that the utility of compute is the ultimate value driver.
This forces the investor to make a real choice now. You can't just buy a basket of crypto stocks and expect them to all move together.
No, you're either betting on compute beta, the AI play, or Bitcoin beta, the monetary premium play.
And we should briefly mention the control group in all this, Cango Inc.
Right, because amidst all this pivoting and leveraging, they released earnings today, too.
And what's the delta with them? They're the hardware manufacturer.
They reported record treasury holdings, 1,778 Bitcoin, and revenue of $196.3 million. They basically proved that the whole miner death spiral narrative is false.
So that difficulty drop, that negative 11%.
It actually helped the efficient players. Canaan just topped 10 exahash per second. They're growing.
So the sector has fractured. You've got the AI pivoters like Cango, the Bitcoin accumulators like MSTR, and the pure play miners like Canaan. That's the new reality.
Exactly. The correlation is broken. And speaking of broken systems, we need to move to the second fracture point, South Korea.
Let's do the what we knew first. South Korea,
Yeah.
land of the kimchi premium. High retail volume, capital controls, and generally a, let's say, laissez-faire attitude from regulators.
It was. But the what's new is that the status quo has been incinerated. We talked about the Bithumb ghost coin incident on the 6th, but it was just reported as a UI glitch that...
Right, users seeing Bitcoin in their accounts that didn't actually exist.
Well, the update today, February 10th, is that the Financial Supervisory Service, the FSS, has upgraded this to a full-scale investigation, and the details are much, much worse than a glitch.
It exposed naked trading. Can you walk us through what that means in this context?
It means Bithumb's internal ledger was crediting assets to users, specifically 620,000 Bitcoin.
Wait, 620,000 Bitcoin?
Yes. Worth roughly $43 billion. Assets that did not exist on the blockchain.
$43 billion.
Yeah.
That is a systemic risk number. That is not a rounding error.
Not at all. It's more than the reserves of most nations. The internal controls completely failed to flag a discrepancy of that magnitude.
And because of that, the political reaction has shifted from, what, observation to
kinetic enforcement.
This brings us to the Democratic Party of Korea. They're fast-tracking this Framework Act on digital assets. We knew legislation was coming, but the content has changed.
Drastically. There are two net new provisions that just rewrite the Korean market structure. First, ownership caps for exchange operators. They're limiting them to 15–20%.
That's a direct attack on the corporate structure. They're trying to break up the dominance of these exchange families, these cable-like structures.
They are. But the second provision is even more significant for the global market. The new law mandates that any one-denominated stablecoin consortium must be bankled.
Bankled, meaning what exactly?
Meaning traditional banks have to hold more than 50% of the equity in any company that issues a stablecoin.
So they are effectively nationalizing the stablecoin rails. Or at least forcing them inside the traditional banking fortress.
They're moving toward a public utility model. They looked at that $43 billion near miss at Bithumb and said, we cannot trust tech companies with the money supply. We need the banks.
Yeah, what does this do to the kimchi premium?
It likely kills it. The premium exists because of friction and, inefficiency. If you have strict bank oversight and integrated stablecoins, that Wild West speculation just dies.
The market becomes safer for institutions, but the retail mania, the kinetic energy that drives that premium,
is being regulated out of existence.
So Korea is moving to a strict bankled model, which is a perfect segue to the United States. Because while Korea is mandating bank involvement, the U.S. banking lobby is fighting to keep crypto out.
It's the sovereign yield battle, and it's all coming to a head today, February 10th.
Okay, set the scene. What we knew. There's this long-standing tension between banks, J.P. Morgan, BofA, and stablecoin issuers like Circle and Paxos.
Right. And what's new is this critical meeting at the White House happening today. And we have some new intel about the red line.
The red line?
The banking lobby, specifically the ABA and BPI, has drawn a hard line in the sand. They are demanding a total federal ban on yield-bearing stablecoins.
We need to unpack the why on that. Why is a yield-bearing stablecoin such a threat to a commercial bank?
It all comes down to the cost of capital. I mean, think about a bank's business model. They take your deposit, pay you 0.01% interest, and then lend it out at 7%. That spread is their profit.
Right.
Now, in comes a stablecoin backed by U.S. Treasuries. T-bills are paying, what, let's say 5%? If a stablecoin can pass that 5% yield directly to you, the user?
Suddenly holding a digital dollar is infinitely more attractive than a dollar in a checking account.
Deposit flight, exactly. The banks argue that if stablecoins function as a payment layer and pay a high yield, it will just drain the regulated banking system of its cheap funding.
They see it as an existential threat. So what's the counterproposal? The crypto industry won't just agree to a ban.
This is where the Bessent doctrine comes into play. Treasury Secretary Scott Bessent has proposed a compromise that's on the table today. It's essentially a class system for digital money.
Explain the classes.
The proposal allows for yield, but only for accredited investors, institutions, the wealthy.
Of course.
So they'd create investment stablecoins that can pass that T-bill yield to sophisticated players. But for the general public, for you and me,
Read it.
we'd be forced to use payment stablecoins, which are legally mandated to have a 0% yield.
That seems incredibly cynical. It protects the bank's deposit base by legally preventing the average person from accessing the risk-free rate on their own cash.
It is cynical, but it might be the only political path to passing the Clarity Act and the Genius Act. This meeting today is the linchpin. If they can't agree on who captures the interest revenue, the banks or the tech companies, there's just no federal framework.
So Korea is handing stablecoins to banks for safety. The U.S. is stripping yield from stablecoins to protect bank profits. It's a fascinating contrast.
It is. And while these huge structural battles are being fought, we need to look at how the market is actually digesting all this.
Right, because despite Cango dumping $305 million of Bitcoin, the price hasn't collapsed.
And that's the final piece, the market resilience. What we knew, the market was fragile. What's new? The data on ETF flows.
What are we seeing?
We got confirmation that U.S. spot ETFs recorded a positive $145 million in inflows on February 6th. This is the crucial counterbalance.
So Cango sells, creates this supply shock, and the ETFs just absorb it.
That's the maturity of the market. I mean, in 2022, a $300 million miner dump would have crashed the price 10%. Today, institutions, BlackRock clients, Fidelity clients, they just stepped in at $68,000. They bought the dip. That floor is real.
And what about the geopolitical risk? We were tracking Iran pretty closely.
That's cooled into what we're calling an entrenched standoff. Iranian Foreign Minister Arachi gave a speech rejecting zero enrichment.
Which sounds negative on the surface.
It sounds tough, yeah, but the market interprets it as stability. It means we're in a long negotiation, not an imminent war. The war risk premium is fading.
Which allows those ETF inflows to drive the narrative.
Precisely. And one last thing on China. We have reports that the PBOC is instructing state banks to curb their exposure to U.S. treasuries while also weakening the yuan fix.
Which just perfectly reinforces the decoupling theme of this whole deep dive.
It does. China is decoupling from U.S. debt. Miners are decoupling from each other. Asia is decoupling from U.S. regulatory styles. Capital is leaking out of the traditional sovereign containers.
So let's synthesize this. We started with asymmetric realignment. The simple narratives are dead. You can't just say miners are a buy or Asia is bullish.
Correct. You have to ask, is this miner pivoting to AI? Is this stablecoin yielding? Is this regulation killing the premium? The nuance is where the alpha is right now.
Before we wrap, I want to leave you with one final, slightly provocative thought building on that Cango news.
Go for it.
Cango is a mid-cap miner. They sold 4,451 Bitcoin to buy GPUs because the equity market values AI higher than Bitcoin.
Right.
There are dozens of other mid-cap miners sitting in the exact same position. Their stocks are lagging, their treasuries are full. What if Cango is just the first domino?
You're talking about a massive surprise shock.
Exactly. We just saw the ETFs absorb $300 million. But if the entire mid-cap mining sector decides to liquidate their treasuries to become AI utilities, we could see tens of thousands of Bitcoin hitting the order books in a very straight window.
That is the billion-dollar question. The ETFs absorbed the first wave. But if this great corporate pivot accelerates, we are going to test the depth of that institutional bid very, very hard.
It's something to watch closely. Don't just look at the price of Bitcoin. Look at the hiring pages of the mining companies. If they start hiring AI engineers, expect a sell-off.
That's a sharp insight.
That's it for today's deep dive. We'll be tracking the fallout from that White House meeting and the Bithumb investigation as they develop.
Stay curious.